Tools for techs, major markets, intermediate projections. Analyzing correlations of the major markets and discovering a cycle shift in SPX and a risky period, not far ahead. We're going to be applying the principle of commonality in this lesson, and that's from the JM Hurst's 8 principles of cycle analysis that we cover in our cycle analysis workshop. This is February 21st, 2024, but I really believe that the teaching here is very evergreen and that you could apply this type of analysis to your own work as you look at the specific stocks or sectors that you're interested in. And you'll see what I do here, because this is quite unique. I think these are charts that you've really never seen before. I reviewed many markets when analyzing this particular time frame, and there were some very strong messages, and I do that all the time. I go through the charts that I show you constantly, and then come up with sometimes slightly different analysis that I had the time before. And in this case, the analysis that I did was so extensive that it really brought to me a sense that the stock market projection that I had right now, which is for a peaking going on here just over 5,000 in the S&P 500, and a correction to March, April, should have a slight shift. And that is only in time. It doesn't really change any part of the analysis other than instead of March, April, it really pushes it out into May. And I'll show you where that comes from. And I think that may be a very important part of this analytical lesson. This timing that I'm going to show you, this little change, I'm going to show you why. And I think that you're really going to get it when you see that. And we're going to look at the comparisons of a lot of markets in here. And I think you're going to find value in that, whether you're interested in the stock market or the bond market or metals markets or the currency markets. They're all going to be discussed here. And this is, I think, a great video. Even though it's timely, it's also evergreen in the approach. So let's switch over now and take a look at the chart of the S&P 500 weekly that we always look at. And there's something a little different down here, and that is that you could see on the bottom there are cycle brackets that are showing a review. When we put in these blue dots like this, then those brackets are saying that we're looking at something that is slightly changed. So this cycle here was a 26-bar cycle, and this right now is a 28-bar cycle. 28 bars or 28 weeks in a weekly chart. You could see that it doesn't change it much. It does align it much better way out over here in the March of 2022. And it was already a little bit off here at that point. It aligns it perfectly over here, and it pushes it out slightly over here into an ideal trough out in May. Now, I'm going to show you where that comes from as we switch over to another chart here. And this is where I think you're going to find it really fascinating, and why I believe that it's better to have the analysis with this shift, with the correction that we're looking for in here, coming out into May. And you can see that blue dot over here that now aligns with this ideal trough over here, this blue projection line right there. And this is what we had in here originally, coming down 4 to 7%. This is now aiming down here about 7%. And I'll show you where those numbers come from also. That monthly 23% is important. That intermediate 50% right there is important. And of course, this number down over here at about 45.80 is important also. But we're really not projecting it down at that level yet. So let's take a look at a little variation of this chart of the S&P 500. And here is basically the same chart, a weekly chart of the S&P 500. And let me just bring this into line where you could see it properly. And what we're looking at are the cycle periods in here. And this right over here is that original 26 bars. And I'm going to show you the shifted bars shortly. So S&P 500, you can see the cycle rhythms that are in here that we were looking at, the expected period over here where there would be a decline out into late March or early April, and that's what we were looking for. Now, I'm going to make a little comparison in here for you to see, because I want to begin to show you the look at how to compare this against the sectors, and that's what we're really going to look at. So let's say that we were looking at the S&P 500, and let's say we wanted to compare that to the look at the something in the tech sector, let's say the SMH. So I'm going to go back here to the S&P 500, and you can see that cycle right over there that we're looking at. And let's look over here at SMH, and you can see as I bring that cycle up, it was pretty similar. You could see that we're looking for a decline over here into early April. So that aligns with the S&P 500 that we were looking for, and that shows you kind of a comparison. But what I really want to do, let's go back here to the S&P 500 on this chart, and then come back to this chart right over here. And what I want to do is I want to compare it not only against the SMH, but against a lot of sectors. So let's go here, and I'm just going to bring in the sector comparison and look at this. So this is the Hurst principle of commonality at work. It says that markets and security price movements have many elements in common, and particularly they tend to have common highs and common low points that coincide with the cycles. So on the bottom here are the cycle brackets of all of the sectors, or a lot of the sectors, that I wanted to compare. And this is the S&P 500, that dashed line, the one that I said needs shifting, and I left it like this so that you could really see what's important. So if I highlight this right over here, you could see that's the SMH that we looked at, which comes out, that's the blue one right over there. This is the XLK. You could see that tracks it pretty well. And then when I look over here, we could see the, what is this? This is XLI. This is Dow Jones Transportation Index. And you could see all of them, how they align here. Now, this is what's important, and that's this nesting that's going on right over here. You could see that when these sectors nested, there was a pretty sizable decline right over here, because there was corrections going on in all of those sectors at that time. And the S&P 500 fell pretty hard right there. S&P 500 fell hard here as they were all correcting again into this time frame. So this is the bottoming phase, this is the declining phase, the bottoming phase, the rising phase, the peaking phase, and then the declining phase again. So when you get into this declining phase, money flows come out of all of the sectors at once generally, and you get the market declines, as you see right over here. So look at the amazing look over here. Now, while they lined up perfectly over here and pretty closely over here, they're starting to spread out a little bit more over here. So this could be a little wider or choppy period. But what I want you to see in here is that the S&P 500 really needs to be widened. In other words, that cycle that we're looking at right there, which is at 26 bars, I'm just going to change this over to 28 bars. And I know that comes out to May 12th. So let me just move this to, I think it's one more click out. Wrong one. Let me just find a place to grab it properly. And let's see, this should be now 28 bars. That's May 5th. That's May 12th. So this is the way we have it lined up on the blue dotted cycle bracket on the S&P chart right now. So I just shifted it, and now you could see how it really lines up nicely in here. And it told me that I needed to make this shift in the analysis and change the projection out into this time frame where instead of March and April being the weakest time, maybe it peaks even in February or March, but you don't really get an acceleration to the downside out until here until maybe late March, April, and into the May timeframe. You can see how this is lining up with the other sectors that are right in here. What is this one right over here? The biggest one right there, that is XLE. So the energies actually happen to be in a very different pattern. They're much earlier in their rise as money is flowing into the energies right now. and that trough is much further out there. So you can see I'm comparing all of these sectors in here and how this lines up so nicely, and that tells me that just like we had over here into the trough period, or here, there is very likely to be a declining phase into this period out into this April-May period. So it shifted out about a month based on what we just did. So now let's compare this. Instead of looking at the sectors, let's switch this over here and look at the country ETFs and compare this to other country markets. And you can see in here, look at this beautiful nesting period right in here as the market fell into that period. And what do I have in here? Well, that's EWZ, Brazil, that's FEZ, that is the Euro top 50 stocks. Here you could see I have the S&P 500. This is EWG, Germany. This is EWJ, Japan. This is EPI, that's India. And you can see that they all came into this time frame in October where we looked for that decline in the market, and it came. Now we have the S&P 500 already shifted in here, and you can see that this is the next time frame out in here, which is maybe late March out into the May, even June period for some of these other countries where this correction comes. Now look at this here. Where they came down over here, it really wasn't that decisive where they were lined up here. But this overall fell 1,000 points in the S&P 500. This decline over here was 833 points as you got the nesting going on right in here. A really nice nesting that was very clear here in all of the countries, 377 points. This was 504 points right there as they all nested here. And you could see here in this April, May, June period is where these countries are going to get liquidated based on all of this continuity that you see in here, this harmonicity, I want to say, and that really calls for 450 to 750 points on the downside here in the S&P 500. This is that 450, this is the 450 point level right over here at the 38.2%. This is the 50% here, and that's 500 and that's the 450 point level. This is the 61.8. That's 500 or almost 600 points, and this is 750 points down to the 78.6. So that's the way this lines up. This is really what I want to project in here, is that this is that period of risk that we've been talking about. It just slightly moves out by a month or so, and you can see all these countries in here that line up with a pretty good decline there in the stock market. So if there's going to be a big decline here in the stock market, and big is really not, these numbers are not very big relative to bear markets. This is just simply, modest corrective numbers right over there. Still, as the market moves down and money moves out of stocks, they're very likely to be lowering interest rates. In other words, buying the bond market. So let's switch over now and just look at some comparisons in the same time frame as I compare this to the bond market. So this is the bond market and DXY. So during this period that we expect that the stock market is going to be declining out into this period, April, May, and maybe June, that's a period where you could see right over here, the bond market, this is the 10-year notes, is likely to be moving to the upside, rallying. So if the 10-year notes are moving up, then interest rates are moving down. If interest rates are moving down, then the dollar is less appealing. Money moves out of the dollar, and this is the dollar, and you can see the dollar moving down while interest rates are moving up. While the bond market is moving up and interest rates are moving down, and the stock market moving down at the same time. You get that money liquidating out of the stock market, therefore interest rates falling, the bond market rallying, and the dollar declining during that time frame. So that's how the correlations work. That's how it sets up. And you can see how important it is to be looking at, all of the correlations the way I just showed it to you right now. Let's just take a look a little bit more at this, and we'll look at all the currencies in the dollar, because we said that in that time frame, April, May, the dollar is likely to be falling as interest rates are falling at the same time. This is some of the other currencies. So there's that right over here where you see the euro moving up right over here. That's the euro, or that dotted, at the same time that the dollar is moving down, because they're inversely correlated. This you could see right over here is the US dollar versus the Japanese yen, and that will be declining during that time frame also. And here you could see the US dollar versus the Canadian, and that will be declining during that time frame also. And we're just entering into a period of risk pretty soon in the US dollar Canadian, which is phenomenally good. So that's it. Canadian moving down, the US dollar versus Canadian moving down, the US dollar versus the yen moving down, the US dollar moving down at the same time that the euro is moving up, inversely correlated. And all of that is happening while the stock market is declining, because it is causing interest rates to fall. You get that? Stock market falling, that's when interest rates fall, because the Fed won't be enticed to do anything until the stock market moves to the downside. And that causes weakness in the dollar, as we're showing in here. So we're looking at all of these correlations right there. And now one more thing. Of course, if we're looking at the dollar falling during that time frame, we're looking for the metals to be moving up during that time frame, because they are mostly inversely correlated. So let's take a look here as I look at the metals and miners, and you can see right over here during this period into April and May where the stock market is falling right there. You can see that I have gold, silver, and then I also have GDX, SIL, SILJ. And you can see in here that there's a time frame in here where this right over here is the SILJ, the junior silver miners, moving up during that time period. This over here is the GDX moving up during that time period. This is the silver market moving up during that time period, and the gold market moving up during that time period. So all of these are showing upside movement while the dollar is falling and while the stock market is falling. I just want to prove that to you. Let's go back to these charts over here, and let's take a look at the gold market /GC, and you'll see in here that that during this period right now that we're in, we're expecting a little more decline, but here is April and May where we're expecting it to move up. We look over here, this is the silver, and the silver is expected to move up during that same time frame. Let's go over here /SI, and you can see silver moving up during that same time frame. Right over here, this is April and May right there, and silver completing this correction before that during the March period into April, and then moving up right over there. And the opposite of that would be the dollar, $DXY, which should be moving down during that time frame. And you can see here we're projecting a declining dollar out into this May time frame, maybe out even into June right over there. So the correlations are amazingly lining up when we look at that. All of that is just absolutely phenomenal. So what I showed you here, using the principle of commonality, which also lines up with inverse analysis that we have in some of these, is that the stock market needs to be shifted out slightly on that chart that I showed you. And one more time, let's go back to that so that you can see SPX, and I'll be sending this out for our members very shortly, that it makes sense that it's going to be shifted out into that cycle right over there. The alignments barely change, but it just pushes it out by 1 month. When you see that. Not that big of a deal. You saw all of the correlations in there as the country ETFs align into the same period of a liquidation. The same thing for the market sectors, a period of liquidation in there, which could be much sharper to the downside than I projected in here. We're looking for 4 to 7% as something of a modest pullback during that time frame. because we talked about the market getting back up to those highs later in the year after this spring correction. It could still happen if the decline is 10%, but we're not projecting it to be that extreme right now. So at the same time, as the stock markets move down, it's likely interest rates will move down. That will influence the dollar moving down. That will influence the currencies that are related to the dollar moving down, like the dollar yen, dollar Canadian. At the same time, inversely, the euro should be moving up, and often the euro is moving up in line with the metals. And that we showed you is that April and May is the time frame that the metals should be moving up. Holy cow, that's a lot. I had to look at a lot of markets you could see to come up with that type of analysis and to lay those all over on the charts properly. That meant figuring out the cycle periods on each of those, putting them over the appropriate charts, and then seeing how there is commonality in the troughs that we're looking for. Again, those troughs all lined up, bring a period of liquidation. That puts a risky period for the stock market here out into, we're just going to call it, anytime the market wants to top between now, probably more likely in the early March period, and then the acceleration of the downside probably into the April and May time frame. I hope you found that extremely valuable, that you look at, this type of analysis and apply it on your own, even if doesn't get to the extent that I just did it in right here. And I or Arvi or Matt or Katie will see you in the next segment.